This is the March Elevation Market Update. Today, I'm talking to Noel Doiron of a Vice President and Regional Investment Consultant with Rowe Price. She has more than 15 years in the finance industry, and she joined Rowe Price back in 2018. Welcome, Noel.
Thank you, Natalie. Happy to be here again today.
All right, so we're just going to dive right into it today. There's a lot of alarming headlines right now, including our favorite word, recession, and some even saying that we're headed for a new Great Depression.
Well, I would say let's alleviate those fears right off the bat. There's certainly no shortage of headlines to talk about and talk through today, obviously, given the major transition, right, from one administration to a very different administration. And one thing I always like to start out with, before we dive into the R word and the D word and all the things that are very scary, is transitions typically create volatility. We're feeling that today, but they also create opportunities, and we're seeing some of those today. And I know that we'll be able to talk about those later. But when we think about recession, depression, right? So a recession technically is two consecutive quarters of negative GDP growth. I think if you look back at the past 10 to 15 years, we've really had I would say just some overhype of recession in the media, and politically from both parties, making it feel or seem like it's a really, really bad thing when it is essentially a very healthy and normal part of a business cycle. It does tend to lead to, stock market losses for a temporary period of time. It tends to lead to a small component of job losses over a very short period of time. But it does tend to be a very healthy reset for our economy, getting us to lower inflation, getting stock prices to where they need to be, kind of setting a blank slate. And what we would say about where we are today with the word recession and the possibility of it. It isn't our base case. It's not what we think necessarily is going to happen at T. Rowe Price. However, if you do consider that a component of our GDP and therefore GDP growth is government spending, right now we all know this new acronym DOGE. We all know that DOGE is going in pretty heavy-handed with a chainsaw, right, and hacking off a lot of government spending, a lot of government jobs. And so, if we do see a very sharp decline in government spending, that could be one thing that tips us into a modest or very even minor shallow recession. Now, I do want to say, let's kind of step back and think about what that means. We're talking about government spending, a pullback in government spending potentially leading to a recession. This is not, what some of us experienced back in 2008, where, we had, people who had to show zero paperwork to take out $1 million mortgages, where we had really bad business practices. We're coming into this period from a position of strength in the U.S. economy. Corporations are very strong. They went through a lot in 2022 and are much more efficient and leaner because of that. And for the most part, consumers are okay. There are cracks there, but they are okay. This is not, this deep dark place that we're entering a period of turmoil through. This is a period of strength, or a position of strength, that we're entering a period of potentially more volatile environment, which we've all experienced over the past couple of weeks. Now, before I stop, I do just want to mention or touch on that word depression, right? Depression is like nowhere near what we're thinking about today. Depression is very, very dramatic decline, like 10% or more decline in GDP growth, and it tends to persist over a period of years. That is in no way, shape, or form where we think we are going. If anything, again, not our base case, not kind of where we think we're going. If anything, a very shallow recession here in the US.
Right. And like you were saying, a recession isn't something that we should be really, you've said in the past that they've been over engineering to trying to avoid a recession. That's really not something that we need. It's not good to never have a recession. It's bad when all we see is just up in the market.
Right.
So if investors can see through the uncertainty and the fear and all of that, can actually benefit from a recession because there are good opportunities for investors.
Absolutely.
So Noel, where do you see the economy today? Do we see it slowing down?
For us, it's I would say it's twofold tough to read through some of the tariffs that we're seeing right now, the tariff on switching on and off, and what the true impact of that will be. But when we look at the economy and we look at American businesses and American consumers, we don't hear a lot of companies, waving the white flag and saying, we're about to start plummeting in terms of our growth. We've seen, to be fair, a few airlines and a few different industries that have come out with more cautious guidance. But overall, we feel like the economy in general, this is a services-based economy. People are still spending money. As long as people are spending money, the economy here in the US is going to be strong. And, by the way, when we look at where we started the year to the end of the year on the S&P 500, we think that the S&P does end up positive from where we started the year. It basically, showing that we should still have some economic growth. Now, will it be gangbusters like it was the past 2 years? No, not. I think we can all agree we're probably not there, but we do see positive economic growth, and we do see companies that are fundamentally strong in the US.
Yeah, last year was a great year in the markets. If only every year could be like that, right?
It's what we wish, but that's
Yes.
that's why we take, the risk is that not all years will be like that.
hmm So obviously we had all of those government layoffs, significant ones. Do you think that we're going to see a lot of job loss across the board?
We don't. We do think the government jobs, and now we're seeing that being challenged, right? Where you got to hire these people back, that was unlawful to fire all those people. We do think that there is going to be some confinement to government, maybe other select industries with job losses. But like I mentioned before, if you think back to 2022, we had companies go through another reset. I think we could sit here and say today that in 2022 we had a recession, right? Now we've had an amazing bounce back since then, so it doesn't feel like that's the case. But we had companies in 2022 who, Amazon was a great example where they definitely overbuilt for a COVID period and came out of COVID and they had to pull back on a lot of jobs. Meta was another example. So we've seen some of these really large companies here in the US that have already gone through that. They're already leaner, they're already more efficient. Very unlikely that we're going to see these massive job losses from major companies here in the US.
So you mentioned 2022. As many as you may remember, 2022 was a painful year. Bonds did not hold up their end of our bargain, and both stocks and bonds dropped. So let's talk for a moment about bonds and where we're at with that.
Yeah, I think we always in this industry preach diversification and having a diversified portfolio. And then 2022 hit, and it felt like that whole argument went out the window because we had the Federal Reserve, trying to pull in or rein in inflation by hiking interest rates aggressively. And when you have the Federal Reserve that is hiking interest rates as rates are going up really aggressively, there's a negative correlation with your bond returns, with bond prices. So interest rates are going up and bond prices are going down. So that's why you didn't see, too much green in portfolios in 2022. We're through that now, right? So now we're in a position where coupons are higher. So if your coupons are higher, that's a better cushion for your bonds and you're getting more reliable and attractive income. And because we have the Fed that's not, if anything, they're going to be cutting interest rates, bonds are acting more like bonds. So if you look at the, ag bond index, and I'm talking on March 18th today, if you look at the ag bond index, that index is up over 2% this year, right? Your treasury bonds are about flat. And it feels a lot better than, looking at the Magnificent Seven or the Elite Eight, which is Mag 7 plus Broadcom. So, bonds are holding up their end of the deal finally, and we think that they will continue to do that. So, diversification in bonds and in other areas this year is back.
Yes, bonds are they're acting more typically this year. If you've had a meeting recently, you can see that your portfolio is not seeing the big losses that the S&P, the market at large, is seeing, which is exactly what we want. Right. So where is T. Rowe seeing opportunity to invest right now?
Yeah, so this is such an interesting question because, again, you think back to the last 2 years and what's dominated the market. I've already called them out: the Magnificent Seven, the Elite Eight. It's been truly a handful of stocks that have been driving the market up. And if you did not own those stocks or enough of those stocks, you maybe didn't feel the euphoria that other investors did over the past 2 years. Well, now we've kind of flipped that on its head, right? So now those 7 or 8 stocks are really struggling this year. They're really struggling to put up positive numbers, even. So now we've got a market where that concentration risk with those 8 stocks at the top seem to be pulling down the whole index. But as Natalie pointed out, if you really look inside the S&P 500 or other areas of your portfolio, you're probably going to be pretty impressed with the performance. I already mentioned, the core bond index is up over 2% year to date. You've got value stocks, large cap value stocks that, depending on which one you're looking at, they're up, mid to high single digits this year already. International, specifically international value, is up 15% year to date. So you think about these other areas in your portfolio that over the past couple of years, you're like, why do I own these things? This is why you own them, for periods like this where you need that diversification. And that's really where at T. Rowe Price, we're telling clients, like, make sure that you have exposure here, because although you haven't wanted to for the past few years in this period of volatility, this is where you can really at least feel a little bit more stable and feel like you're making lemonade out of some lemons that are being thrown at you in the markets today.
Yeah, and like you're saying, it's important to have that exposure ahead of time. By the
Mhm.
time that you start seeing that trend upwards, it's already too late to jump on that
Yeah,
bandwagon.
right.
So for the rest of 2025, where do you see the rest of the year going?
Yeah, like I mentioned, we do think that, the broad US stock market is modestly up from where we started the year. Maybe, feeling very good relative to where we are today, since we've seen the market fall since the start of the year. So we do think that we could have, modestly positive returns on the S&P 500. And when I say modestly, I'm talking single digits. I'm not talking 20 to 30% returns this year. So we do think, there's going to be these periods of volatility that we have to work through. The market's working through a lot of uncertainty right now, right? That's, the worst dose of medicine for the market is uncertainty. And unfortunately, we're working through a lot of it. I think what we have to remember about this administration, and, I think you could refer to it as Trump 2.0. He's kind of doing what he said he was going to do, tariffs, immigration type stuff. But we also have to remember some of the positive things, or the market positive things he said he was going to do. We still think that those come through, like tax cuts, right? Less regulation. So that tends to be pro-business, pro-consumer. And we do think that that starts to work its way through his administration, or his priority list through the rest of the year. I think you also have to remember, whether you like him or not, he's obviously very divisive. His ego is very much tied to the stock market. So I don't think, and we don't think at T. Rowe, it's not necessarily where we're putting all of our chips and why we're investing the way that we're investing. But if we were to hypothesize about who, Donald Trump is as a person, he wants the stock market to do very well under his watch. So we do think that, he is watching this. He's going to continue to watch it. He's going to make sure, however he can, that markets turn positive again. So, where I would kind of leave you with that is, first, the U.S. economy, we feel like, is in a good spot. Second, we feel like we have a president who is very chaotic. There's no arguing that. But at the end of the day, we do think that he wants the market to be up on his watch. And then, third, I think you're going to see other areas of opportunity, like we've discussed, other positive areas in the market and your portfolio than you've seen over the past couple of years, whether that's, your dividends, your bonds, international positions. So, overall, are we, euphoric and shouting from the rooftops about how excited we are about the markets today? Not necessarily, but we do think that we're in a strong position and we're going to weather through this and we're going to see positive returns by the end of the year.
Great. Yeah. Well, hopefully we do see that positive return in the market this year. If anything, I think it'll be interesting. It's definitely not going to be a boring year in the markets.
That's
Um,
right.
Noel, thank you so much for joining us today. And our next elevation market update will be in May.
Great.
And this is the March elevation market update. Today, I'm talking to Noel Doiron of a vice president and regional investment consultant with Rowe Price. She has more than 15 years